There, welcome into another edition of Market Takes. Today we are breaking out, diving into really gonna explain exactly what we saw from today's blowout, way higher than expected US retail sales report. I am Dion Rabouin, your host, reporter for the Wall Street Journal. Thank you so much for tuning in. I know you could have been anywhere in the world, but you're here with me, and I appreciate that. Look, today's US retail sales report was a big one because it really solidifies a lot of the worries, a lot of the fears, a lot of the expectations that folks in the market had about the economy. The economy may be doing a little too well. We're going to talk through all of that. We're going to talk about what the report showed, how that compared to expectations. We're also going to talk about why this report matters, and this is a big one. Retail sales can kind of be hit or miss. Today's retail sales report was a big one because it really confirmed a lot of what we had seen from previous reports, looking back at January, and kind of talks about the new narrative for markets and the new narrative for the economy. So a big report today. Of course, we're going to talk about the market reaction. We're going to talk about the environment coming into this report and how the outcome of what we saw from today's report. And I think today's market action will be very interesting in terms of setting the tone for the future. So we're also going to talk about that. And then, of course, we're going to talk about what comes next for both markets, the economy, everything else. So diving into it, let's get into the numbers. First of all, retail sales rose 3% month over month. This is the biggest increase in a year. So going back to January 2022, as you see right there up on your screen, this is the biggest increase we've seen in retail sales from the previous month, going back for a year. Now, if you look, you saw those two reports you see right there on your screen, November and December. Coming into this report, we had seen retail sales declining, moving lower. Well, now we have seen retail sales spike up and jump at the fastest pace in a year, saying, no, the trend is not for this decline to continue. We are setting a new trend where perhaps, and 1 month is not a trend make. Don't forget, 1 month does not a trend make, but we are seeing a reversal of what looked to be a trend of retail sales being lower, being negative, and now turning into a different direction. So just wanted to put that chart on your screen to illustrate what we have seen from retail sales going back a year. This really blew out expectations. Expectations for about a 1.9% increase. This is a full percentage point and then some increase over what economists surveyed by Dow Jones had expected. And that 1.9% was pretty high, considering that we had had negative 1% decline in retail sales in December and in November those were the first two negative reports in a row that we'd had in about 2 years. So this completely changes the trajectory. Analysts had been talking about the potential for this report to really exceed expectations even coming in, but I think this exceeded even some of the higher expectations among economists. Car dealers were a big part of this. Auto sales surged during the month. Gasoline station receipts. We're seeing a rise in oil prices. That again, that's going to put some pressure on some of these increased consumer sentiment reports that we've seen. Citi had expected about a 2.4% increase in retail sales. Bank of America actually hit the nail on the head. They track their own credit card and debit card spending data, and their economists had predicted exactly this result, 3% increase on the headline number, as well as a big increase in the control group, which strips out some of those more volatile aspects of the report. So Bank of America's credit and debit card spending actually showed a 5% increase in household spending year over year in January, compared with a 2.2% increase in December. So more than doubling the increase year over year from January through to December. U.S. retail sales on excluding autos, according to a MasterCard survey, had increased almost 9% year over year in January, with retail e-commerce spending growing 5% or 4.8% year over year. So we saw Bank of America data, we saw MasterCard data, we had some of this real-time data coming into the report showing that Americans were increasing their spending and increasing the pace of that spending. That's not good news when you want to see inflation numbers come down. Also, we saw Social Security checks increase 8.7% at the start of the year. That is the largest inflation adjustment in decades, and that's going out to about 70 million Americans. So we saw a number of things pushing this number higher. Now, that government piece where Social Security checks Folks who are on Social Security and Social Security, SSA, things like that, got a bigger than expected increase. Most folks probably didn't expect to see the big difference in what they got in that January check, and that may have contributed to this. So this may not be sustainable. We will see. But again, a lot of folks also spending that extra holiday bonus money, some of those holiday bonuses, some of that extra holiday cash maybe they got from grandma, grandpa, Aunt Susie, things like that. We'll see if this is sustainable, but a real turnaround in retail sales report. I want to jump into the details. Going to nerd out with you just a little bit. I know I don't want to get too nerdy for you, but we're going to nerd out just a little bit here. I want to quote something that my man Joe Bruce Willis, he's the chief economist at RSM, he pointed out that the key control group that feeds into GDP increased by 1.7% on the month. That's a big increase. Excluding autos and excluding gas, increased by 2.6% on the month. And ex-gasoline sales, then when you price out gasoline sales, which were big increases, that rose at 2.6%, or I'm sorry, that advanced at 3.2%. So even when you take out gas, autos, things like that, the big things that push this report higher, you're still seeing a solid increase in retail sales. That shows you that this is broad-based, this is across the board increases in spending. Joe Bruce Willis says the economy remains overheated and rates need to be increased. Now remember, Joe Bruce Willis talks to the Fed. He has direct conversations with those guys. He's the chief economist at RSM, but he is also an advisor to the Federal Reserve. He knows what they're doing. He knows what they're thinking. He has conversations with them. He says that rates need to be increased. That's a direct quote. I also want to talk about my man Mohamed El-Arian. He is the chief advisor to Allianz and the president of Cambridge and Queens College. He says, quote, look for this to do two things to markets that the jobs report also did, though to a lesser extent. Push back recession calls and nudge up rate calls, as in expect higher rates and expect a pushback, not a removal of recession calls, but push back recession calls as in later in the year, as in potentially moving into 2024 or later in 2023, as a lot of economists and asset managers had predicted that rates were going to stay high, we were going to lead into recession. Then the Fed has to respond to that recession, lower rates, and that gets the economy and the stock market booming again. Because you've got those low rates, you can borrow money cheaply and then go out and do things like add some things to your home, maybe buy some new furniture, things like that. Well, this pushes that further down the road and pushes those rate calls up higher. It also shows the U.S. economy not cooling. The Fed really wants the U.S. economy to slow down, wants people to stop spending money so those prices stop rising. We're seeing that that's not happening. That last retail sales report in December, as I mentioned, was down 1%. This is a complete reversal and a reversal in a big way. So why does this matter to the market when we look out at those asset markets? And we're going to talk through those. Don't worry about that. But the big picture response is that this changes the narrative again. Remember, going into the end of last year, we had this expectation for things to slow down. Recession worries were coming in. Folks were a little bit dour and down and bearish on the market. Then the start of this year, you saw that switch get flipped, and folks were bullish. You saw that risk rising. You saw cryptocurrencies jumping, high-flying tech stocks jumping, a lot of the risky assets in the market really taking off. And you saw those bond yields coming down. You saw a new environment. And now, ever since that jobs report that really started the year, the people said, uh-oh, that's not good. Increasing jobs report that we saw at the beginning of February from January. Then we saw CPI earlier this week say inflation slowing down, but not as much as expected. Now we get this retail sales report today, and that shows no. Inflation is not dead. Rumors of inflation's death have been greatly exaggerated, and that could mean some big things to worry about in the market. The big thing, my man Torsten Slok, he is the chief economist at Apollo Global Management. He said something on a recent WSJ podcast that I thought was very interesting. He talked about the no landing scenario. Folks have talked about a hard landing or a soft landing. Well, Torsten Slok is saying we could be looking at a no landing scenario, as in inflation just doesn't come down. Baked into a lot of the assumptions about the market this year was this expectation that one way or another, inflation is going to come down. Talked about this in a recent video. Basically, investors are saying, we know that inflation can't just keep going higher. It's got to come back down. Well, was it going to be soft or is it going to be hard? Torsten Slok is saying, well, maybe we're looking at a no landing economy. Maybe inflation doesn't come down, and that is going to throw a monkey wrench into a lot of expectations and asset management allocations, projections, all of that stuff for this year. this really confirms and solidifies that to start the year, we are not seeing inflation cool off and go away. We are seeing inflation sticking around, and that is going to force some folks to reevaluate what they think about the market. Listen, the good news about the economy, because 3% retail sales, that's pretty good news in a vacuum, but that could be bad news. Could mean more rate hikes from the Federal Reserve, rates staying higher for longer. Deutsche Bank actually came out even before this report was released and said, we are revising our expectations and our outlooks. We think the Fed is going to raise rates to more than 5.5%. We think they'll stay there for longer. That impacts everything. It also means the economy is not responding to the Fed's actions. The Fed raised rates at the fastest pace that they have since at least the 1980s, maybe the fastest they've done in history last year. And the economy is still showing resilience. Consumers are still going out spending. Prices are still rising. That's not a good sign because it means maybe the Fed needs to take more drastic action. One could say maybe it means the Fed needs to reevaluate what they've done and consider that maybe the economy is not responding to their actions the way that it always has. But that's not how these guys think, and we've heard from them. We've heard from Fed Chair Jay Powell. We've heard from New York Fed President John Williams. We've heard from a lot of folks in the Fed who say, no, it just means we need to raise rates more, raise them higher, keep them higher for longer. Some folks have said, hey, Fed, clearly you're not getting it. Maybe you need to try something different, but the Fed is not looking at it that way, and it's all about the Fed. Listen, we got unprecedented stimulus from the federal government. The $3 trillion CARES Act. We got the American Rescue Plan from President Joe Biden. We also got that almost $1 trillion stimulus from President Trump on the way out going in 2020. So we've gotten about $6 trillion of federal stimulus pushed out there. The Federal Reserve, $9 trillion worth of money added to its balance sheet. These are huge actions, and this is a lot of money that's just sloshing around in the economy. It's not going away, even with the Fed raising rates. We've also got something that hasn't been talked about a whole lot, unprecedented corporate profit margins. You had the net profit margins for corporations rising to about 14%. That was unprecedented, never happened in history. Corporations had never made that much profit on their sales in the history of some of these accounting metrics, and they were making that as this inflation was rising higher. So we are seeing big things that are pushing inflation higher, and they're clearly not going away. But, there's always a but, right? We are seeing net profit margins falling, and that could be bad news for the stock markets. Bad news for the stock market, as there have been worries about earnings estimates being too high, about folks being a little too rosy about the outlook for stocks. The blended net profit margin for the S&P 500 for Q4 2022, that's the latest one, is 11.3%. Now, not only is that lower than what we've seen, these historical numbers, that's lower than the 5-year average, and that's lower than last quarter's net profit margin, and it's way lower than the 12.4% net profit margin that we saw a year ago. So if this is the actual net profit margin, which is an estimate right now for Q4, it would be the lowest one reported since the end of 2020. That's a big decline, all right? And so we're seeing net profit margins for corporations really start to hit the skids. We're also seeing Americans borrowing a ton of money. Consumer debt and credit rose at a record pace last year, and delinquencies now are up about 40% year over year, according to data from RSM. That's not a good mix. We're seeing a lot of worries about credit. We're seeing a lot of worries about the economy at the same time as people are borrowing more money, at the same time as we're starting to see people not pay back that money and get hit with those delinquency fees while the cost of borrowing money is rising at the highest pace. Credit card rates are at the highest they've ever been. So we're seeing record borrowing as borrowing rates are at record highs. We talked about this in our Inflation Has Sparked Record Credit Card Debt video in October of 2022. Check that out if you haven't. This retail sales report, though, keep in mind there's only a partial picture, doesn't include things like travel, housing, and utilities. The Commerce Department will have a report out about that later this month. Be sure and check that out. So before I leave you, you know we got to check in on the markets. We are seeing stocks down across the board, but not a huge reaction. I think because some of this was already priced in because we've seen that real-time data. So we're seeing stocks down, we're seeing bond yields up, but just a little bit. You know, you're not seeing a huge sell-off in bonds because, again, we had seen this move of higher. You've got the 6-month Treasury yield up at about 5%. That's the highest it's been since 2007. So we had seen some of the stocks lower, bond yields higher. The big move, I think, has been really in the currency market where we're seeing kind of across the board the dollar had been lower and now it's kind of picking back up. You're seeing the dollar up higher against the British pound, dollar up by about 0.5% against the euro. And you're seeing the dollar start to rise. That's going to make things more expensive. It's going to make corporations, it's going to hurt their profits. Again, this could be a major warning for the stock market, and I don't think investors right now are factoring that in, as we're just seeing some smaller sort of moves on the stock market. Listen, wrapping it up here, this report backs the narrative that we had coming in, that after that jobs report, after that CPI report, this retail sales report kind of confirms the economy is not slowing down, adds a little bit of nuance to it. One thing I want to do is throw up this chart here of the Conference Board's leading economic indicators index. And as you see there on your screen, over the past few months, we've been consistently moving lower. That's those business surveys where they reach out to business owners, purchasing managers as they're called. If you look out at a number of indicators, including the stock market, things have been getting worse and they've been getting significantly worse. They haven't been as bad as they are right now, according to this index, since 2007. You see there at the beginning of your screen, 2007 was the last time we saw indicators this bad for this long consistently. So just wanted to put that on your screen to just illustrate what we were seeing and what this environment means. The odds for recession have been pushed back, but they have not been pushed out. That's something to keep in mind. Listen, here's what to watch for next. Now, we've got the President's Day holiday coming up next Monday. But don't forget, tomorrow is a big day. We get the PPI inflation numbers. That's what businesses are paying for their materials. We know that when business prices rise, usually they pass that on to consumers. They have been for about a year now. Housing starts and the Philly Biz Outlook, the New York Fed debt and credit report. Watch that. That will be big because if it continues to show consumers taking on more debt, that could be a sign that folks just can't afford it, but they have to keep borrowing on, piling onto their debt loads. This is a story that I think is not being covered enough in financial media, the increase in consumer borrowing and credit, because people are saying, I don't have enough money, but I got to keep buying stuff. Then you're going to watch for that leading economic indicators report on Friday. That's going to be updated. So we will see the latest report on that chart that I just showed you. We'll see if that keeps moving down or if maybe that ticked back up. And on Tuesday, we will be right here for Market Takes, talking through the existing home sales data, and that's going to tell us about the housing market, the thing most sensitive to increases and changes in what the Federal Reserve does. Listen, this has been Market Takes. I know you could have been anywhere in the world, but you were here with me, and I thank you for that. I'm your host, Dion Rabouin. We will do it all again right here on Market Takes next time.